Hello, and welcome to our third quarter strategy review. We held our meeting in this room Thursday, June 27th, and we had a special guest with us on the phone, Tom Logan, who is with Blackstone Funds. And Blackstone Funds are a very large fund manager. They manage over $6 trillion in assets. And Tom is their equity market person. In any case, we also had, of course, with us on my left, Bob Toomey. Bob Toomey, Vice President, Director of Research. And on my right, Len Skeena, Vice President and CEO. We would like to just refer you to our second quarter review, which is online, as all of our others are. And at that, we set a trigger, as we always do, but unusually in this quarter, we did pull that trigger because we did get something that was unexpected. We felt by something unexpected happening, we would see increased volatility in the market. And we did. What happened was the Trump administration decided to implement a 25% tariff against over $300 million worth of Chinese imports. This, frankly, was totally unexpected, and it did cause some concern. Some concern that we are continuing to deal with today as we were yesterday. Currently, they are at the G20, and we don't really know what will happen. However, we discussed it thoroughly and decided that although that could continue to cause market disruption, it was not going to cause a total market disaster. So it is now something that we're continuing to monitor, but we're not actually going to deal with it as far as our investment strategy. And we have, as we'll hear from the fellows, gone back to our more normal allocations and feel we've vented that quite well. So with that, I'd like to turn it over to Len to talk about the fixed income markets and Fed policy as it affected these recent markets. Len?
Thank you, Stan. Interest rates are normally what is affecting fixed income returns in the bond market. And interest rates are driven by market forces as well as very strongly influenced by Fed policy. The Fed can control what's going on with short-term rates. And when we met 3 months ago, the Fed was very intent on raising interest rates. At that time, they had slowed the rate that they were raising interest rates, but there was still a strong sentiment that if the Fed was going to act in one way or another, they were going to raise rates. That sentiment turned on a dime at the end of March, and in May, it exponentially increased to a sentiment whereby the Fed would actually be lowering interest rates due to a global market slowdown as well as the May jobs report and some other things going on. The Fed has decided that they are not going to be raising rates going forward, but most likely going to be lowering them. What this meant is that we wanted to re-look at our bond portfolio, and we have removed from the short-term interest rate area a floating rate fund that we were using to take advantage of rising rates. The rising rates at this point, since they're not going to happen, are not something that the floating rate will allow us to benefit from, and so we've gone to a straight treasury allocation across the board from the short-term rates through to the long-term rates. We continue to skew our allocation towards the short-term rather than towards the long-term right now. We are more heavily weighted on the short and the intermediate side than we are on the long. With that, I'd like to turn things over to Bob to talk about the equity markets.
Thanks very much, Len. So the equity markets, as Stan alluded to, are, I think, at a very interesting juncture right now. This coming Monday, which I guess will be July 1st, the economy will have completed its longest recovery in history, at least in modern times. And also, on top of that, the stock market has just a couple of months ago passed its 10th anniversary, this bull market so we're at a very interesting juncture in the equity markets, and there's a lot of talk and discussion on Wall Street about where we are in the cycle. And this was part of our discussion at the meeting. And I think at this point, given the environment that we're seeing right now with respect to corporate earnings, the job situation, and the Fed policy, that we believe that the economy is still on solid ground and can continue to grow, and that is positive for stocks. As I mentioned also, the Fed does appear to be increasingly accommodative, and I believe that Fed Chairman Powell's comments in the most recent FOMC meeting essentially said they are prepared to do what they have to do to maintain a healthy economy. On top of that, we have global investor confidence in the United States and US markets. So I think all of these are contributing to the reasons why US stocks are at or near all-time highs. As Stan alluded to, the big wild card right now is the China tariff situation and the trade war, if you will. There is a very important meeting tomorrow, June 30th, Saturday, I should say, an important meeting tomorrow, Saturday, between President Xi and President Trump. We were speculating on what might come of this meeting, and as of now, I think it's impossible to predict the outcome of this meeting. We don't expect anything really material. The best we can hope for, I think, is smiles, handshake, and maybe some sort of modest truce, which I think might be interpreted as positive by the equity markets. But ultimately, this conflict, if you will, this trade conflict, we believe, is going to be a very long and drawn-out process that the equity markets are going to have to live with. So the implications for the stock market longer term are several. I think that there could be some modest impact on earnings for companies that have a high level of export exposure to China. I would also point out that the U.S. exports to China are less than 1% of our total GDP. So it's really a very small portion of our total U.S. economy. So in the end, I don't see it as having a major impact on the U.S. economy. Looking forward, we still feel positive about U.S. equities. We see stronger second half earnings growth. As Len mentioned, we think the Fed is more inclined to cut rates, which will help equity valuations. And our position right now is we continue to see sort of this slow melt up in equities continuing in the second half of 2019, albeit with the normal and expected normal volatility that we can see from day to day and week to week. With that, I'd like to turn it back to Stan to talk a little bit about REITs.
Thanks, Bob. REITs continue to be a very strong part of our portfolio, as they have been, frankly, through the entire history of the firm. One of the things that we consistently like about REITs, and they continue at this stage, is a very high dividend return. In some cases, they're even somewhat tax protected, and that certainly hasn't changed at all. However, we do now have 3 different REIT offerings. One of them is the one we've had for virtually, I think, forever, or at least it certainly seems like it, which is VNQ, which manages REITs in all three of the primary areas, large apartment buildings, shopping centers, and large office buildings. We did expand to the broader index, which now exists, that covers all the core REITs. And so you see that in the portfolio now. And we frankly, over time, will probably tend to migrate towards that versus the VNQ, which is broad-based, but not quite as broad-based. But we also, this quarter, again evaluated our additional REIT holding, which is medical properties. Medical properties we got into originally because we wanted a little diversification away from just the general REIT population, specifically the large shopping centers and the retail situation. As I don't think I have to point out to anybody, it's been performing very well, and we continue to like it. As I mentioned, we generally own REITs because of their high dividend. In the MPW, the medical properties, that dividend is more than 1% above what the general REIT core investment is. So again, REITs continue to be something we're going to continue to be with, and again, we like them, continue to like them at this point. With that, I'd like to turn it back over to Len to talk about the international markets.
Thank you, Stan. Looking at the rest of the world, currently there's a global slowdown, and we also are engaged in something of a trade war with China at the time. Given both of those things, as we look at the various markets, there's really not an area of the world that we prefer to the United States at this time. So we have de-emphasized our international holdings, and we have actually gone to minimal allocations. We're maintaining minimal allocations in the international market, going only into the developed areas, not going into any emerging markets due to this trade war with China, and just not feeling comfortable going into those areas at this time. And we're going to continue to just maintain our holding in the IFA area and keep that at, as I said, our minimal allocations, 90% of normal. With that, I'd like to turn it over to Bob to talk about the other changes in our holdings.
Thanks a lot, Len. So, as you heard both Len and Stan discuss, based on the results of our meeting and our discussion about a whole variety of things, Fed policy, the trade situation, we have decided to go back to a more normal allocation on our equity holdings. In fact, following the meeting and our vote process on our holdings, our equity allocation now is very slightly above neutral or normal. And the reason for that are the things I discussed previously, improving second half earnings outlook for the U.S. U.S. equities continue to be considered the strongest market in the world, and U.S. markets continue to attract capital from all over the world. And as I mentioned, Fed policy remaining quite accommodative. So within large cap, we have maintained a sector emphasis on strong dividend growers through our holding of the SDY. And we also maintain a position in healthcare technology, which has done not only extremely well, but we expect it to continue to do well because of the inherent growth of the companies that are held within that ETF and the inherent and highly stable growth in the healthcare markets overall. In the developed equity area, we did make an interesting change. We removed our telecom sector ETF, which I would say did its job as a lower volatility holding during what we thought was going to be a fairly volatile period. And we've replaced that with a software and services ETF. We like, within the technology sector, we like software because we believe it's more stable in terms of its growth. It's more stable in terms of its growth relative to hardware. And it continues to be a very high growth area within the technology sector. And we believe it should contribute to enhanced growth in your portfolios. As Len mentioned, we remain at our lowest possible allocation for international equities, and within fixed income overall, we did see a very slight increase overall in the long end. We're still overweight on short duration, the shorter end. So with that, I'll turn it back to Stan for closing comments.
Thanks, Bob. And thanks to all of you for tuning in. We appreciate it. As I mentioned, all of our strategies, quarterly strategies, are on our website. I do once again refer you back to those if you'd like to get a little history as to what our decisions have been, which frankly have generally helped us manage the portfolios in such a way to meet our clients' long-term objectives. I don't want to leave, though, without talking about what we're going to use as a trigger, because each quarterly we always set a trigger, and that trigger is set so that we can say, this is something we did not expect, but rather than waiting and dealing with it when we're in the middle of what's going on, we set the trigger, letting us operate more calmly, more reasonably. And as I said earlier, and it bears repeating, we've set triggers for years. We've only pulled 2, the one last quarter. So the trigger for this quarter, as you heard actually all of us talk about Fed policy, talk about Fed direction, we've decided to use the generally amorphous concept of what the Fed is doing as a trigger. Again, the anticipation is that the Fed will be lowering rates over the next 3 to 6 months, which was unexpected, by the way, last quarter when we had our meeting. So there's also some friction, I guess, between the Fed chairman and the president. So these are the kind of things we're going to be watching. And while it's unlikely that that will do anything in terms of causing us to take action, that's what we'll be looking at as a trigger. So again, thanks again for watching. Hope you tune in again next quarter.